Welcome. What can I say? The bloodbath continues, not just in India, but across Asian markets. US equity indexes lost over 10% in just 2 days, Thursday, Friday. And this has happened only 3 times in the last 75 odd years. The hope was that President Trump would offer some hopeful statements over the weekend when he saw that kind of a bloodbath. But all we got was, in quotes, you have to take medicine sometimes. The hope still is that if the US economy takes a turn for the worse, Trump may soften his steps. And so we are trying to understand how bad the hit is for the US as of now. I have 2 experts for that. First, I'm going to be joined by Robert Sockin, the global economist at CITI, and in a bit, Steven Englander of Standard Chartered Bank will be joining us on currencies and bonds. First, Robert Sockin is here. Robert, I'm deeply grateful that you are joining us at what is a very late hour in New York. Let me come to the cut to the chase. If the tariffs stand as they are, what will be the impact on the US economy?
That's a great question, and thanks as always for having me. There is a big debate about the exact magnitude of the negative effect that these tariffs would have on the US. Most estimates tend to range from a drag of around 1 percentage point on growth to 2 percentage points on growth from all of the tariffs that have been put in place if they were to stay in place. I would be on the upper end of that range, so I think the drag is closer to 2 percentage points. So we really have to be getting very concerned about recession risk here for the US. I don't think that's necessarily the base case yet, but it's a rising risk with a lot of downside to where we were a few months ago.
Well, you know, I'm assuming that this 2% that you're talking about, GDP cut, is your worst case. What would be your base case? Because we all have to assume that there will be some pullback on tariffs.
As a base case, we have less than that right now. As I said, we're still waiting to see what the exact kind of contours of the tariffs look like, because we've had a lot of tariff announced. How much of those stay in place? Also, the administration has signaled that more tariffs are likely for sectoral tariffs in terms of things like pharmaceuticals, semiconductors. Those seem to be in the pipeline from what the administration is signaling. So we don't, as I said, have a recession in the call as of yet, but the growth forecast is coming down. And I think if all of these things come to fruition, the balance of risks are that we end up with a drag that's closer to 2 percentage points off of US growth. So if you thought the US economy was going to grow near 2% this year or a bit above, you have to be marking that down to somewhere to 1% or below, and maybe even getting down to 0. And that's why I think that the recession risk is high, because it's easier to get to bigger numbers for these tariffs in terms of the drag on economic growth than smaller numbers.
Okay, so 0% possibly flat economy this year. What's your take on the global economy? Will global economy do worse than the US economy?
I think for the global economy, there's going to be a lot of negative effects as well, because these tariffs are going to create challenging environments for many major economies around the world. And if you look last year and the year before, the global economy grew at about 2.8% per year. That's about a hair below its 3% trend. A couple months ago, we were expecting a very similar story for 2025. Global growth in the 2.7 to 2.8% range for this year. But I think with all of these tariffs put in place, you're looking at global growth that's going to be in the low 2% range, and could even dip below 2%, which maybe would not quite be a global recession, but would be very weak by historical standards. So, looking at the global economy, I think there are enormous challenges. And one thing is clear, that this will be a significantly softer year than we saw in the last few years.
Okay, so significantly softer than 2.8%. What's the thinking among US economists and financial markets now? Do they see Trump administration pulling back if there is more damage, for instance, on Monday morning?
Yeah, this is a key question, because right now we speak with other economists, strategists, market participants, companies. They're all very frustrated by the tariff policy and the headwinds it's going to create. And you see that reflected in things like business and consumer sentiment surveys. You see it reflected in measures of financial market sentiment like equity prices. And I think right now the administration has shown a lot more willingness to tolerate declining equity prices and risk to economic growth than we would have anticipated. I do think at some point there has to be a level where the economy deteriorates, where the equity markets deteriorate, where the administration would likely reconsider some of these policies. But so far, that doesn't seem to be the case. And certainly, they've shown a much higher threshold for pain when it comes to these policies than we or many others would have expected.
Yes, I mean, no weekend statements was a shocker. We didn't expect the US 10-year yields to fall below 4%. Now, as the Citi Economist, what is your expectation on US yields? And of course, that'll be connected. What do you expect from the Fed?
Yeah, absolutely. And those two things are related because, what's getting, I think, a lot priced into what's going on in the 10-year Treasury is expectations that the Fed is going to have to cut policy more. And I think the key question is under tariffs, they're a stagflationary shock. They raise inflation and they lower economic growth. And that goes in opposite directions for the Fed. Raising higher inflation tells you should be have hawkish policy, and weak growth says you should have dovish. We think that they are going to ultimately put more weight on the growth side and cut rates in this environment. So as we get into the next several quarters, I think you're going to see several rate cuts from the Fed, potentially more than that, depending on how the situation evolves, and that itself is going to weigh as well on the 10-year. So I think a 10-year that's somewhere in the high 3% range would make sense in that environment. But again, it's a very fluid situation, and it depends on how many rate cuts the Fed ultimately puts through due to the growth risks from these tariffs.
Yeah, I am not envying people at the Fed. And you can be really confused. Okay, finally, from an India standpoint, what's your sense? Our exports to the US is only 2% of our GDP, but we are exposed to the global economy, which you are saying is likely to weaken. So how are you looking at EMs in general and Indian economy in particular?
Yeah, and for emerging markets, we were very constructive going into this year. India had one of our best forecasts for the year, growing around last year's pace, very rapid growth, and other emerging markets holding up very well as well. EMs grew 4% last year in aggregate. We were looking for 3.9% this year. But these stresses are going to create substantial headwinds. And for India in particular, I think what we're seeing from the administration there is they are trying to find a way to negotiate with the Trump administration. And maybe there is a path forward. So far, there's been some mixed signaling in the news. It hasn't progressed as much as maybe many would have hoped. But I do think there is a scope for that. Hopefully, we'll see that over the next few months that many countries are trying and able to make deals with the administration. But for India, as you said, even though we had a very strong growth forecast going into this year, and even though exports to the US aren't particularly large, I do think that much lower global growth environment is going to be a headwind for India. So India overall is probably relatively well positioned. But if these continue to create substantial headwinds for the global economy, it's going to be a challenging environment for everyone. So I think India well positioned, but not without its challenges, much like every other economy in the world right now.
Thank you, Robert, very much for staying up for us. And we will be touching base with you oftener than we did, considering the times we live in. Well, let me welcome another person who has been waiting up for us very patiently, Steven Englander, the Managing Director, Global Head of G10 FX Research and North American Macro Strategy at Standard Chartered Bank. Steve, again, to you too, thank you very much for staying up on a Sunday night. Let me quote the last Trump statement we got. Sometimes you have to take medicine. This gives the impression there is no pullback from his side. What do you expect now, for instance, say, on Monday in the markets?
Well, we're starting off as a bad day, but I think um, I think the market sometimes seems to have a mind of its own, and we're beginning to see central bank central bank cuts getting priced in where we had thought that they would be reluctant to cut. The Fed now has a 70% chance of cutting in May. Um, it's possible sentiment will turn around a little bit. The market seems to want to get stimulus from government. So with some rate cuts, with some announcements of fiscal stimulus, it's possible that things will begin to stabilize. But again, everything is up in the air.
Mm. Yes, I agree with you. Up in the air is so right. Let me first discuss currencies before I come to bonds. The dollar index fell below 102, from all the way from 104 on April 1. But now it has moved up a bit, 102 and a quarter. How do you think we should think about the dollar index? What kind of a range would you see for the dollar index?
Well, I'm a little bit puzzled that it fell so sharply. Normally, when it's a risk-off event, the dollar tends to rally. And what you've seen is, traditional sort of safe havens like Swiss and yen do very well, even though they are very much, on the target range of the Trump tariffs, and they're very low yielders. I think we could see over time that the gains, certainly the gains that Swiss has made, could be eroded. I think Japan is a little bit different because they're raising rates when everybody else is cutting. But I think that the sort of this triumph of the safe havens, could turn around over time.
Okay, so the safe havens return. Do you expect, therefore, a dollar recovery?
Well, we do expect it to recover in the second half of the year. That a lot of this is sort of related to the need for revenues because of the tax bill that the Republicans want to pass. And I think as we begin discussing that bill in more detail, the fiscal implications and the sort of extent of the tax cuts, are going to sort of be seen as being stimulatory certainly for the U.S. economy. So I think that will lead to a stronger dollar, and I also think that as some of these tariffs get negotiated down, this sort of risk premium, that sort of hurt the dollar against the majors, that will be eliminated, and the dollar will make gains against them.
Okay, when you say gains, can you give a range for the DXY at least?
I think we'll probably go up to, in DXY terms, 105, 106 by the end of the year. Okay. That we will see a major dollar turnaround as the effect of the tariffs wear off and the importance of the fiscal move becomes clear.
All right. Let me come to bonds now. Yields fell shockingly below the 4% mark. What's your sense? Why did it fall so much? Is it pricing in recession? And what's your range for US 10-year yields?
Well, I think the market assumed very quickly that the implications would be a recession. And, they're taking yield down, the global recession. On the other hand, you look at it, these are, supply shocks, not demand shocks. We're going to see, fiscal moves in a bunch of countries, not just the US, but other countries are talking about, sort of easing fiscal policy in order to maintain demand. I think once we get past this, episode of deep fear, that the risk is much more that the bond yields start going up than stay at these levels or go further down.
Okay, actually, I should have asked you this first. What's your view of the US economy? Do you also see a recession?
No, I mean, a recession is a big word, and typically it means, 2 quarters of negative growth. I mean, because of quirks in the GDP numbers, we could get that, but it's not going to be a 2020 recession or 2008 type of recession. And I think would be relatively mild. At the end of the day, I'd say this so far, they've been careful not to tariff things where they don't have the logistics in place, like items that cross the border multiple times, yes, where you don't want to tax it every time it crosses the border. The de minimis, they delayed for some time till they were able to deal with it. I think if it's just a question of tariffs and money, things will slow down, but it's not going to be a recession. If it gets to a point where we say, oh, we can't make cars because the wheels, we can't import the wheels, the tires for the cars, that would be much more serious. But, you know, paying 10% more for the tires, it's no fun, but it's not, that wouldn't be cause of a recession.
Yeah, I take your point, and I guess the administration will pull back at that point. We have to wrap up on that note. Thank you very much, Stephen, yet again, for staying up for us. We will take a rain check from you. We'll bother you a lot. Wrap up on Bazaar Chart Busters coming.